This is a video on how to buy your first rental property step by step. Give me less than 25 minutes and you'll be on your way to buying your first rental property. Hey guys, I am Mr. Maciek. Welcome to the channel where I talk all about making money, investing in real estate, and building your net worth. If that interests you, please do me a favor and subscribe below. I would really appreciate that. Now, this is the step-by-step guide to buying your first rental property. If you are interested in investing in real estate, then please watch this video all the way through. It's only gonna teach you, and even if you get just one nugget you didn't know about, you are on your way to winning. Okay, now let's get started, and this is step number one. Smash that like button. Well, that's not really step one, but please do click the like button. It really helps teach YouTube that you like this kind of stuff. Okay, keep in mind, you do not need to do these step by step, but you can actually work on some of these steps simultaneously. So step number one, let's get some down payment money saved. Now, for investment property, the down payment amount is definitely different than your owner-occupied property. But the math is really simple. So basically, for every $100,000 of loan amount, you're going to need $15,000. That's a 15% down payment. Although I do recommend you try to go for the 20% down payment because you're going to be paying PMI, the private mortgage insurance. And this is basically money that leaves your pocket and goes to somebody else. So if you want a higher cash on cash return, then try to save up 20% at the beginning so that you can get rid of that. Although that's not to say it might not be a good idea to go for the 15% because there are certain circumstances where that does make sense. And actually there is one exception. You see, if you're gonna buy a multifamily property that's between 2, 3, and 4 units and you're gonna live in one, then officially that's not gonna be an investment loan. That's actually gonna be a primary occupied loan. And that way, even though you have 1 rental, 2 rentals, or 3 rentals, and therefore you are buying your first rental property, your down payment can be as low as 3%, 3.5% on an FHA loan, or if you're a veteran, you can go for 100% loan amount, 0% down. Okay, great. Now, step number 2 is we need to prepare ourselves so that we will qualify for the loan. This process can definitely be done while you're actually saving the money for your down payment. I highly recommend it. And I'm going to break it down to 4 subcategories of getting ready to qualify for a loan. Number 1, the most important thing that banks look at is your repayment ability. Basically, do you make enough money to pay them back? And keep in mind, it does not actually matter how much money you make. It matters what's showing up on your tax returns and what kind of income is it. So for example, if you are a W-2 employee, that is gold. That is exactly what you want. And you want to be in the same job for a couple of years. And there's other speculations we'll discuss a little bit later. But basically your repayment ability is you need to be able to show through pay stubs that you can pay this loan back. Okay, now the second point on getting ready to qualify for a loan is your credit score. Now you need a minimum 680 credit score. And if you already have that, congratulations. If you don't know what your credit score is, then just download Credit Karma. That is what I use. It's an app. You can also go to creditkarma.com and create an account over there. And it's going to help you track your credit. Also going to show you all the derogatory marks and everything that's going on. So along with this, go and start improving your credit. And I say that because just because you actually qualify for a loan with your 681 credit score, you're going to get a better interest rate if you're at 720, 760, or 800. Those are all going to be different interest rates that you're going to get, and the better your score, the better interest rate you get. So think about it this way. If your credit score is, 675 and you're still saving up money, just work on your credit, and as you improve your credit, you're going to basically have a lower interest rate, which means a lower payment, and it also means a higher principal pay down on your loan every single month. So not only is your payment lower, but a larger percentage of this payment goes towards your principal. So you're actually getting a double win. So I highly recommend that you just research, how do I fix my credit? In fact, I have a video on how to fix your credit. I'll put it up in the card above here, and you can start researching on what you can do to fix your credit. There are so many resources out there for free on how to improve it. And whatever you do, please do not pay anybody to fix your credit for you. Those are usually companies that take either too much money for a good service, or they offer a poor service and some shady techniques that is not going to help you get qualified for a loan because they're going to close out your credit cards and so on. But anyway, research credit scores. It's very important for you to have a good credit score in order to qualify to get a loan. Okay, the third thing you need to do is look at your debt to income ratio. Depending on which kind of loan type you have, the ratios are going to be different. FHA versus conventional, those are different rates. If it's your investment or primary occupancy, that's a different rate. A veteran, different. So anyway, you basically need to look at your debt to income ratio, your debts, what's showing up in your credit report as a monthly expense, and your income, what are you showing as your monthly income through pay stubs. And if you are self-employed, it gets a little trickier, but you still have to show it somehow that there are bank deposits and that you pay yourself. So basically look at all your debts, see how you can reduce them, and look at all your income and see how you can improve them. In the worst case scenario, your ratio cannot be higher than 50%. If you can, try to keep it at about 35%. And lastly, in getting ready to see if you even qualify, you're gonna need a good employment history. So what that basically means is that you have to show them your pay stubs. If you're in a W-2 job, like I mentioned before, that is gold. That is exactly what you want. And that is the ideal situation. But also, they look at how long you've been on the job. They want you to be there for 2 years. And if you haven't been there for 2 years at the same job, that's okay, as long as you're doing the same type of job. So if you're a plumber and going to a different plumbing company, still being a plumber, that's usually just fine. But if you're going from being a bag boy at a grocery store to an insurance salesperson and you've only been at this job 6 months, that's not good. That's a change of occupation. That is a high-risk client. So they don't want to lend you on that. And I will say that cases can be made. Your lender should be able to write up a case as to what happened. Maybe you were going to school to be an insurance salesperson and you got your license and you got a job and you're kind of moving up in the world. And sometimes there are cases indeed that are going to convince the underwriter for the loan to go and get you pre-approved. And as part of this employment history, you're going to have to show that the money that you're getting from your pay stubs is going into a bank account. So not only do you show them the pay stubs, but then you show the deposit, and that number has to match. So if every time you make a deposit, you go cash it at one of these check cashing places, that is not helping you. In fact, that's deliberately hurting you. So stop doing that and start depositing it into a bank account. Because the other thing the lender is going to want is these bank statements, and they're going to ask for 2 to 3 months of bank statements, and you're going to have to show all your income, all your expenses, everything's going to need to be clear. Basically, if you lie to the lender, nothing is going to help you because the lender doesn't actually make the decision to lend you money. Who does? The underwriter. And you do not have direct access to talk to this underwriter. So basically, if you're lying to the lender, you're lying to yourself. And they can go and pre-qualify you, but you just won't get the loan at the end of the day. So be 100% honest, be fully transparent, and whatever they ask or whatever comes to mind saying like, maybe I should tell them about this thing, tell them, because they're on your side, and usually they do not get paid unless they close a deal. Which kind of reminds me, if you go to like a large bank like Bank of America and you go apply there because you've been doing business with them for 10 years or something, know that these people are on salary and their motivation to close the deal is about this high. They do not get paid for closing deals. But if you go to a mortgage broker or a mortgage banker that's commission-based, then you're going to be dealing with someone who does not get paid unless they close the deal. So they're going to be more willing to work harder and be more creative on how to structure the deal so that the underwriter likes what he sees and that all the federal guidelines are being met and that no mortgage fraud is being committed. Okay, step number 3 on your path to buying your first rental property is the following. Take step number 2 and implement it. Go apply for a loan. You need to go get pre-qualified. So this is extremely important. Let me tell you why. If you don't talk to a lender first, you're actually just wasting your time. That's the bottom line, because you're going to go online and use mortgage calculators and figure out how much you qualify for, because they have a whole bunch of calculators out there. And then you're going to find out the real deal, because those are just online calculators. And then this is the actual application process. And what are you going to find out is that you're going to qualify for a lot less, and you're not going to be able to buy the home that you wanted to buy as your rental property. Let me tell you what I see as a real estate agent all the time, and it's really sad because people don't talk to agents first to get advice like this. Basically, they research, they save their money, they try to fix their credit score, and then when they finally are ready, they've been waiting 2 years saving, spending all this time, effort, and energy, they find out that they don't qualify for some reason or another. And all of this could have been avoided if they just had talked to a lender first, or maybe a very experienced real estate agent that knows all the ins and outs of the lending industry. And those two people can make a plan together for you so that you can buy a home in 2 years. That is what I do for my clients, and I don't care if you're 5 years out or if you're 2 months out. If I can make a plan and help keep you accountable, I want to help. Now, not every agent and not every lender is created equal, so you need to find the right people that vibe with you and are actually going to go out there and help you. Now, the good news is that you don't actually have to pull your credit and have a hard inquiry on your credit report to understand if you pre-qualify or not. If you are already using Credit Karma, then you can just go and check where your credit score is and let them know, like, hey, on my assumption, here's all my documents, but don't pull my credit. Just go and run it with this credit score right here. And they will tell you, based on that credit score, what your current interest rates would be and what you qualify for. So here's the other thing: if you don't go and get qualified, not only are you wasting your time, because you're probably going to be looking at properties that are overpriced for your budget, but also when you do find a gem and you're just like, this is it, I want to move forward, I want to put an offer in, the sellers aren't going to take you seriously. And if there are any other offers on the table, they're probably going to be higher, and you're going to be on the very bottom of the importance level of the offers, because you are not pre-qualified, and that's telling the seller that you don't care enough to spend 15 minutes on a phone call with a lender and gathering 15 minutes worth of documents to send to that lender. You're not even willing to take that step to see if you're pre-qualified? That doesn't sound like a serious buyer. And that's exactly how I look at it as an agent as well. So as a real estate agent, if I have an offer on one of my listings and that person is not pre-qualified, I will not even consider recommending my sellers to sign it. I will present the offer, and I will explain all the pros and cons. And then my professional recommendation will be, tell them to go get pre-qualified. And you can go get a pre-qualification letter in 1 day if you rush and you get everything done right. So it doesn't take very long. I'm going to recommend to my sellers to basically say, I'm not going to reply to this offer until I see a pre-qualification letter. And also, there are different types of pre-qualification letters. There's like the quick and dirty napkin version, as I call it. Basically, it's just like, a coffee with a lender, and you tell them your situation, and they kind of know from experience, like, yeah, you know what, I think you will get a loan, or no, you know what, I don't think you will. Then there's the second type, which is a DU pre-qualification letter. Basically, it's a letter where they have received your documents, they've run it through the direct underwriting software system, and it has spit out a yes or a no. And that is the second type. And the third type, which is pretty rare to see, but these are golden, because what they are fully underwritten pre-approval letters. They do take a little bit longer to get done, and very few lenders do them. Definitely no big banks do them. And basically the way it works is the underwriter gets all your documents, they run it through the direct underwriting system, they get you approved through that, and then the underwriter himself will actually go and research everything about it, do your income verification, every pay stub, everything gets looked at, and then they issue a letter saying that you are fully underwritten, which basically means that you will not fall through as a buyer. Only the property might fall through. Because to get a loan, first of all, the client has to be qualified, and then the property has to qualify. No roof leaks, no structural damage. There's a whole bunch of rules that they have. Overall, they don't come up that often, but still, you are going to have the golden ticket, so that when you present your offer, and you might be in a multiple offer scenario, your super strong pre-qual letter is going to outperform everyone else's, and that seller might just want a guaranteed sale and loves his house and knows the house is in good condition, and they might pick you even at a lower price, just because you have taken the time to get the ultimate of pre-approval letters. Step number 4, start shopping. That does not mean go inside every single property that comes on the market. Don't waste everyone's time. What you first want to do as an investor is you want to drive by every single property. I mean, honestly, if you're approved for $250,000, then anything from $175,000 to $250,000, maybe even more, you should go and drive by it. At the very least, check out the neighborhood, check out the neighbors, check out the exterior, and figure out, is this an area that I would be comfortable being a landlord in? Let me tell you, there are some sketchy areas out there. I own property in these sketchy areas. I don't care, I'm all right with that, but I would never send any one of my family members to my rental properties by themselves. So it's about you. Are you going to want to be in a place that is going to be a high return but a low income property? Are you going to be kind of in the middle where you are actually dealing with working class people, working class jobs, having a consistent paycheck? Or are you going to go to the middle class, just spend a little more, get a little bit better? Or are you going to go to luxury, which basically you're probably not even going to break even? So you just drive by every single property that comes out there and familiarize yourself with it. After that, pick the top 5 to 15 and look at them every week. So every week you want to have between 5 and 15 properties that you see that you had not seen prior. And I'll tell you, by the time you have seen about 45 to 50 properties, you will definitely be very well equipped to recognize a good deal that is a good potential for a rental, because you're just going to have all this info that you absorbed over all these weeks. And then when you're ready to offer, you know you're offering on something solid. Now, just a couple tips about this. I personally recommend single family homes. I wouldn't go into the condos, because condos, and also that includes townhouses and villas, I wouldn't recommend them due to the HOA fees that they have. Sometimes they're called the COA, the Condo Owners Association. And this is basically money that you're paying to an association to manage things that you can manage yourself, like mowing the lawn. So I don't recommend that you go that route, because it's basically less money in your pocket. Also, there's no big upside. You can't add square footage. You can't add an extra bedroom, bathroom, or anything like that. You're pretty much stuck with that 2-bedroom, 2-bath, or whatever it is that you bought. And I don't recommend that, because you want to find things where you can add value too. Also, golfing communities, beachfront communities, all of these are going to have rules that you may not want. Like, golfing communities might require you to join a golfing membership, and let me tell you, they are not cheap. Once again, just more money out of your pocket, less profit. And don't forget to include duplexes, triplexes, and quadplexes. These are a great opportunity. I'll get into it in just a little bit about why these are so good, and also how you should change your criteria when looking at them. Anywhere between 1 to 4 units is considered a residential loan. So you're not going to the commercial loan space, you're sticking with residential, which have the lowest interest rates and the lowest down payment required. Okay, step number 5, crunch your numbers. I cannot stress the importance of this. You're not going to get into a good deal that's going to pay you every single month if you don't do this step very, very precisely. So here's the deal. When you purchase a property, you're going to have what's called PITI. What does that mean? PI stands for principal and interest. TI stands for taxes and insurance. So this is basically your mortgage payment. And if you've put less than 20% down, you're also going to add PMI to it. And that's not a very big amount, but once again, less profit in your bottom line. So you can use mortgage calculators online to figure out what your PITI would be. And basically just take the purchase price minus your down payment, hopefully 20%, and add your interest rate over 30 years. This is very important. Take 30-year loans. I'll explain why. But then you're going to have your principal and interest payment. Let's just call it $1,000. Then you can go and actually check out the taxes of that property. And then you kind of have to do a general number on insurance. And it really depends where you live. So just call around some of the agents and see, do they know how much insurance is for this property, so you can get a general idea. But overall, I use about $150 per month for estimating insurance. And then after you have your payment, you want to know what is the rent amount. And you can go on, just Zillow.com and search rentals in the area, kind of see what a 2-bedroom, 2-bath or a 3-bedroom, 2-bath single family home would rent for in your neighborhood. You can also use Rent-O-Meter. There's a dash, it's rent-o.meter.com to go get an estimate of how much something would rent for. And now you have the dollar amount, how much it rents for. And you have to start deducting things. So you take the monthly rent amount and you subtract 10% of it. That is for capital expenditures. It's basically big ticket items like your roof, hot water heater, air conditioner. Then you'd have that minus your 10%, and you'd remove another 10% from that big number, and that is for your management fee. And I know you might manage by yourself, but you still want to take that out because you're probably not going to manage it forever. And then the next thing is, once again, you remove another 10%, and that's just for general repairs throughout the year for random things that break, like a refrigerator or a leaky faucet or anything like that. But wait, we're not done. You still have to remove another 5% for potential vacancy. And if you do a really good job by finding the right tenant, you'll have a 0%. But in your number crunching, you want to find out the worst case scenario. So you got your number, your rent amount, minus 10, minus 10, minus 10, minus 5%, and then you have your dollar amount. And that dollar amount should be higher than your PITI plus PMI. If it's not, you're in a negative cash flow. If it is higher, then you're in a positive cash flow, and whatever that number is how much you're gonna be making per month. Okay, step 6, write offers. Now remember, step 4 was like go and look at a lot of properties, and you have to really know what you're gonna be offering on. You don't wanna just go and blanket offer everywhere, because a lot of the agents are gonna start hating you, and then they're gonna recommend not to accept your offers. So you really wanna just pinpoint the really good deals, and you wanna write offers on those. You're not gonna get a lot of your deals accepted if you write enough of them at the right price. You know, if it's a buyer's market and there's plenty of inventory, you're actually going to be able to kind of lowball those offers, maybe take 10, 15% off of the price. And if we're in a seller's market like it is right now in February 2021, you pretty much have to offer over asking price. Okay, step 7 is assuming that you got it under contract, and all you really have to do is go through your inspections and make sure that the quality of the product is good enough for you. And then you have to go through your insurance and appraisal. So you want to go get your appraisal, make sure that it qualifies and you can actually get a loan on that, and you want to make sure that you can get insurance at a reasonable rate. Step 8, fix it, rent it, repeat. Go back to step 1. Just repeat the whole process all over again. So basically now you are an investment property owner and you are making some cash flow with it. But wait, let me give you some super important bonus tips. Okay, bonus tip number 1. You want to look for properties where you can add a lot of value to them. So maybe they look like they're straight from 1972 or in the 80s or 90s, and you got some shag carpet and some poor paint color and wallpaper. You want to look for something that you can have some cosmetic upgrades. You don't want to go and replace the whole kitchen and the whole bathroom. You can take those retro things, you can just change the doorknobs and the hinges and paint a little bit, and it's amazing that those old cabinets last a lot longer than these new ones that they make nowadays. Okay, bonus number 2 is super important because I'm a number cruncher, and if you're a number cruncher, you're really gonna get this. It's about the rent amount and the mortgage, right? So if you are renting it at $1,000 per month, you wanna make sure that your PITI plus PMI is 75% or less of this monthly amount. You want to look at the monthly amount, the potential, the one that the lease is actually for. So you rent it for $1,000, then your payments should be $750 or less. Here's why. This is really important. Basically, when the lender on your second investment property looks at your taxes and looks at your income, they're going to take into account the fact that you already have a mortgage payment for a rental property. And they're going to assume that you have a 25% vacancy rate right here. No matter what the truth is and what your tax returns say, they're going to go look at what is your monthly income, $1,000. They just slash 25% of it, and then they assume that only 75% of it goes towards your income. And if that dollar amount is less than how much your PITI, your mortgage payment, plus PMI is, then your debt to income ratio is actually negatively affected by it. And it's a higher percentage amount. So if you lost me on this, just rewind a little bit and watch that over again. So important. I cannot stress the importance of it, because if you just buy one property every year, then you can get 10 properties in 10 years, and it's unbelievable the cash flow and the appreciation that you will get, and the mortgage pay down too. But if you don't use this rule, you're not going to qualify for mortgage number 3, 4, 5, 6, 7, 8, 9, or 10. So please rewatch this, learn it. You got questions? Send a comment below. I will answer everything. I'll make a video that's 2 hours long if you want. Okay, here's bonus tip number 3, is that the taxes that you're seeing for the previous owner are going to be different, and they're going to be lower than what taxes are for you. Now, in some states we have homestead exemption, like in Florida where I'm at, and basically we get discounts if we live there. So if you're buying from a homeowner that's lived there for 20 years, they have had tax deductions and tax incentives, so their payment is definitely a lot lower than what your payment's going to be. Also, the cost basis resets for the property according to the county. Long story, if you want to know how much taxes are going to be, just call your county and ask them to help you calculate it. Okay, bonus tip number 4, everything in terms of repairs costs more than you think and takes longer than you think. So add 25% to any bids you got or any calculations you've done, and add 25% more time. That's it. It just all takes longer. Nothing gets done on time. If you're hiring a contractor to do all the work, you can write up a contract, and in the contract say it's very important for you to get done by this certain date, and any date additional after that, you are going to get $100 less or $50 less per day, including weekends, that it's not finished and finalized. Bonus tip number 5, in the offer, you can ask for the seller to actually pay a lot of your closing costs. They can have a seller contribution towards buyers' closing costs and prepaid items. And this will allow you to take up to 3% on a conventional loan or 6% on a FHA loan of contributions, which is basically going to up your mortgage amount and how much you are borrowing, but it's going to decrease the money out of pocket that you are spending. And where is the benefit there? Well, you're going to have more money in your pocket to make more repairs, or you'll have some money left over for your next down payment in 1 or 2 years. Okay guys, I hope you enjoyed this. Watch this video. It's all about fixing your credit. Watch this video, how to get into real estate investing. It's a different video talking about different things. So please write a comment if you have any questions. Thanks for watching.